Really excited to be here with some of my favorite banking partners. Everybody here, extremely high quality financial institutions that do great work with their clients. We can go over some banking issues and talk about really the evolution of a business and the issues that banks and their clients are facing as they go, and helping clients understand better what the bank is after and what they can do with their financial advisors to help the bank help them grow the business. So a little bit of help me help you here. So I'll let everybody introduce themselves. Eric, if you want to go first.
Sure. Hello, everybody. My name is Eric Johnson. I am a senior VP at Johnson Financial Group. Been a lifelong Dane County resident, UW-Madison grad, lifelong Badger fan, no matter how painful that is sometimes to admit. But I just focus my attention on the Hoops team, which is completely legit. They're going to be super fun to watch this year. We are a family-owned financial services institution. I've been with the bank for 25 years now, and I'm very proud to call Dane County my home.
All right. Good afternoon, everybody. My name's Chris Doering. I'm with First Business Bank. Been with the bank for about 7 years. My role there is a little bit of everything: business development, manage client relationships, and then I also lead our sales team in the Madison market. The bank is headquartered here in Madison, been around for about 30 years. So as our name says, we're primarily a business bank and wealth management group.
Nick Drewsen with WBD. I'm going to provide some SBA perspective to the panel this afternoon. Company I work for has been around 45 plus years. We're one of the top 504 SBA lenders in the country. I've been doing this for almost 20 years now, so work closely with partner lenders across Wisconsin, but me specifically within the Madison area, so appreciate the opportunity.
Kyle Myhre. I'm at UMB Bank, formerly Wisconsin Bank and Trust. I've been with that organization 18 years. I handle commercial banking relationships, like everyone here, business development, managing and helping our customers grow and grow profitably. I cover the southern half of the state for our middle market commercial group.
All right. Eric, gonna start off with a question for you, and then if anybody else wants to add any comments to this, please do. Hey, Eric, where do you see people start the relationship with the bank usually? Are you guys doing equipment loans with them, line of credit? Depending on what industry the client's in, do you see that changing? Where do you try to steer people in terms of how that initial lending package looks?
Well, actually, in my experience, a banking relationship typically starts with a depository relationship or treasury management needs. Credit is sometimes a lagging item. Sometimes it's the lead. I salivate when it's the lead opportunity because that's what I do. I'm looking for new account relationships with growing companies. But to me, a simple start is a deposit relationship, treasury management, supportive services. And if I'm advising business owners about how to start a banking relationship or where do you go, what questions do you ask, my preliminary advice is usually focus on fit. Because there's all kinds of different financial institutions in and around Dane County, credit unions and small community banks and big banks and global players. And fit can mean different things to different people. Sometimes it has to do with credit capacity. Is a bank's credit limit 20 million or is it 100 million? What are my credit needs as a business owner? Sometimes it might have to do with industry niches. If I'm a franchise owner, I want to work with a bank that is familiar with the franchise space. So asking yourself as a business owner, what am I looking for in a financial partner, and what financial institution should I talk to that I think would be a good fit? What questions should I ask to determine fit on the front end is, to me, a really good place to start.
Chris, anything you'd add to that?
Yeah, I think you're spot on with the treasury management piece. That's such a important part of the overall relationship that I think some people get backwards a little bit. But the only thing I would add, I think a lot of times there's an event, whether it's an acquisition or a purchase or a startup or whatever that might be, and that's where we come into play. There's the event, but then it's kind of what you do with that event. And like Eric said, kind of determining of the many banks there are in the area, kind of who aligns best with me. I think what you'll find probably from a lot of us is that we've got access to, we're either the decision maker or part of the decision making team, or we have access to those people locally. I think a lot of times, you lose that capability as banks grow. And so being able to have somebody in the market that your business is in, be an advocate for you within the bank is an important part of the relationship.
Nick or Kyle, anything you'd want to add to that?
I would just add on this, if you're not sure where to start, ask somebody you trust. A lot of our relationships for all of us come from introductions from, accountants, attorneys, etc. I think rather than Googling online, who's the best bank for me, you got to go to those trusted partners.
Great. Yeah, totally agree there. As the company starts to grow and the relationship with the bank grows and, maybe they're asking for a bigger line of credit or a bigger equipment loan, what do you find are some of the surprises that happen that people don't see coming? Chris, thoughts on that?
Yeah, I think small businesses, we try to, when we're talking about financing, I think there's a fine line between, understanding the company, understanding the risk profile, and then being reasonable about, what the requirements might be, whether that's, financial reporting requirements or, underwriting metrics that we use to monitor the business on an ongoing basis. Personal guarantees are always a big topic. Those types of things may start a certain way, but as companies grow and as the debt profile increases, just by nature, there's going to be other things that happen. So I think a lot of that is on us to be able to communicate it. I mean, we're all part of a highly regulated industry. So, our job is to shield the client from that experience and be able to kind of articulate the why behind why we're asking for this. So, if you have $1 million line of credit, it's going to look very different than if you have a $5 million line and some equipment and real estate debt. But again, I think as long as the communication is sort of there on the front end to say, we might only require you to do internally prepared statements in a tax return, but at this debt level, we're going to look for a review and a little bit more frequent reporting. I think people understand it as long as they can understand the why behind it.
Kyle, anything you'd add to that? Surprises along the way
I
as
think
it grows?
The question maybe is asking of, what we're asking for. I think looking at it another way, what surprises people sometimes is maybe they don't have the internal accounting capabilities to provide everything we want. It's a growing pain of growing. All the additional items that a bank would require, they're not ready for that. It isn't just difficult for them to provide, it might be not possible for them to provide without upgrading their staff.
Yeah, Eric, anything that you could elaborate on that with, where a business, things have been good enough the way they are, and then things suddenly aren't, and what things come as a shock to the business owner?
Well, I think business owners understanding that growth is a joint responsibility when it comes to how does it get financed? Is it self-financed? Is it bank financed? And I think, I don't want to speak for my other bank partners up here, but I've always looked at funding growth for a business as a joint responsibility. If a business owner is looking to fund growth 100% via debt, without retaining earnings, without building their balance sheet, without downstroke, it's going to be much more difficult for any bank to get their arms around helping with a $5 million equipment purchase or a $20 million plant expansion. But if the business owner and the bank, the lender, are in concert with that this is a joint responsibility, then I think the likelihood of a favorable result for both parties is much, much greater.
Yeah, agree.
Fair?
Absolutely.
Yeah, okay.
Kyle, so, a lot of times businesses will start off with a piece of equipment debt or a line of credit, and maybe they're not providing a borrowing-based certificate, or, the personal guarantee is there, but there's not really a lot of stringent loan covenants and so on. And then you move forward into a traditional lending package. You might look at asset-based lending, might look at an income-based package. What do all of those things mean, and what's the bank looking for differently in each one of those?
There's a lot of questions in there,
Yeah.
Ryan. Thank you for picking me for that one.
Yes, you're welcome. So maybe let's just start with the difference between, say, a traditional lending package versus what it means to be in an asset-based lending package versus a income-based lending package.
So asset-based can mean a couple different things. In a traditional bank sense, it's providing a borrowing base where the bank is lending based on how much you have for receivables, what you have for inventory. So very detailed reporting requirements on showing us what those assets are worth, right? And I think that's kind of the first step after the basic line of credit is you step up to the borrowing base. Going to a true asset-based lender is really another division of the bank. And I think all of our banks have that, but that's the best way to describe it, maybe a little higher leverage, or sometimes situations where things aren't going well, and we say, this needs even a higher level of reporting, weekly reporting on some of those items. So when you say asset-based, our brains can go a lot of different directions there. But to summarize it, just continuing to give the bank more and more information.
Yes. And then that income-based approach, what does that look like different than traditional and asset-based lending?
So think of it, income-based lending is, let me take half a step back. In a traditional financing package, the bank is evaluating the collateral. What is the value of your real estate? What is the value of your current assets? Going to an income-based approach, this happens a lot in acquisitions. I'm saying, I'm going to buy this business for 3 times EBITDA. Let's just make up a number and say that's $10 million, but there's only $3 million of assets. There's a big airball there. We're evaluating the ongoing cash flow stream as the ability to repay that loan. Usually we're amortizing it faster because there's more risk.
Yep. So, Eric, any specifics that you see differently in those different setups? And
I would just add a little more definition to what Kyle was talking about there. So a traditional bank loan relationship is going to have all of the 5 C's of credit covered. It's going to have, and I'm going to forget 4 of them, but I'll remember at least 1, I promise. It's going to have adequate collateral. It's going to have adequate cash flow. It's going to have adequate management and character behind that management team. It's going to have adequate other C's, okay? That kind of stuff for us is easy to underwrite. It's easy to understand, easy to underwrite. What Kyle was talking about in the latter portion there was, hey, there's not enough collateral here, so we're going to be lending to you against your cash flow, your company's ability to generate cash to service debt that there isn't necessarily adequate assets to cover in a traditional bank loan. That from a bank's lens adds a layer of risk that we need to get our arms around a little bit better, hence additional reporting requirements, hence additional questions. So it opens up a different kind of universe of underwriting, if you will, from the bank's perspective, because the risk profile that Chris referred to earlier increases in that scenario. So we then begin to look at all sorts of different covenants and financial metrics to get our arms around the risk and how should it be priced, and should we offer financing? Is the business getting out over the tips of their skis too much from a leverage standpoint? So there's a lot of differences. Because when most people think of banks, they just think, oh, they lend money. Well, a cash flow deal structure is different than a traditional deal structure, is different than an asset-based lending structure. So hopefully that explains a little bit why we look at things differently based on the risk profile.
Yeah. Chris, anything you'd add to that?
You guys covered it in detail. I think the only other thing I would add is that I think all of those, the cash flow still has to be there, or there has to be a path to it. I think, asset base is obviously very closely monitored, and at the end of the day, you're kind of relying on that collateral base if you need to liquidate. But the point of it is it might be a turnaround, or you might be just break-even cash flow. But I think in any of those scenarios, there's got to be a business case to be made. I would say the only exception to that would maybe be like an asset receivable or account receivable factoring arrangement, which some of us do or have the ability to do. Then you're actually taking that invoice and you're underwriting, your client's ability to make that, to recover that payment. So in the other scenarios, you still want to make sure that, there's a solvent business there, and eventually you're going to get to a point where you're going to get repaid.
Hey, Eric, you talked some about, the 5 C's of being able to make loans, and you guys just talked about all of the things that you need to see. I hear all the time that banks like to make money, and aren't you guys in the business of lending money? I mean, why does this have to be so complicated?
Okay, why does this have to be so hard? Why does it have to be so complicated? Our businesses, just like you guys, we have business models, we have strategic planning, we have business goals and objectives, we have KPIs and metrics that we want to meet. And our profitability is largely driven by the margin between what we charge for loan interest income and what we pay for interest expense. Largely, there's other factors. So when we're relying on the interest income as our primary source of revenue, we need to be right when we lend money. Effectively, you guys may opine on this, but we need to be right 99.5% of the time. Because when we're wrong, we lose money and our margin goes to what, and then we don't meet our metrics. Then you throw on top of that the fact that we're a highly regulated industry that always has somebody looking over our shoulder, whether it's the state or the Fed or examiners or whatever, somebody's always looking over our shoulder. So because of those 2 primary components, we ask a lot of questions, and we try to get our arms around risk and risk management. And then hopefully we get to all the right decisions and we can help people grow, help companies grow.
Chris, anything you'd add?
I mean, if you think about, I think all of us have been in banking long enough to remember sort of 2008, 2009, real estate valuations, and you're looking more on a national level, but you kind of saw what happened, and I think there was obviously a lack of underwriting, maybe a lack of understanding from our part about what we needed to be asking for, the conversations we need to have, complacency among other things. We're in about as good of a time from a portfolio, like a credit portfolio position as you can be in when you talk about being right almost 100% of the time. And that's just the nature of where we are, and I think the businesses that we're working with and the economy that we're in, that's not going to always be the case. So to Eric's point, I think we're going to ask tough questions at times. I think there's a point probably on both sides of the relationship where you may have a tough conversation, and it's probably for the right reasons. But again, it kind of gets back to knowing your customer and kind of knowing what the bank's motives are.
Yeah, I'll just add one quick thing, because I get a lot of calls from people who are trying to start businesses or trying to do big expansions and are frustrated, right, that they can't get a bank loan. And what I think a lot of people don't understand is, a traditional bank loan is your cheapest cost of capital, but it is the most risk adverse, right? So banks are not saying whether you're going to be successful or not. They're just trying to assess the risk of the request, right? And so a lot of the other sources of capital involve giving up equity, selling shares, bringing in investors, right? Those investors have upside. If your business does really well, they get a big return on that. As a lender, best case scenario, that loan just gets paid back as agreed. So when you don't have that upside, you can't take as much risk.
Yeah. Kyle, anything to add?
Two things real quick. I mean, we talked about this before. Banks are not equity. I think that's, when you say it that simply, it sounds obvious, but a lot of our conversations end up being about that. And then the second thing is, yes, we have to be right 99.5% of the time, but we look at that at 99.5% of our dollars lent have to be correct. So it isn't just, it's not 995 out of 1,000 loans. It's weighted on the dollars, right? So when the dollars get bigger, the questions get more.
Yeah, good commentary on why this can be difficult. If you are coming into that, first loan and so on, and loan approval process, how do you make that easier on the bank? How do you move that process along farther? Any advice that you guys have, Chris?
I think it's, trying to have your financial kind of house in order in terms of the statements. I mean, I think all of us are willing to kind of look at whatever quality financial statement you have, but I think sometimes it can be challenging to get the right information. And again, this is a scale thing, so it's different for $1 million company or a $50 million company, but having, whether it's an in-house controller, CFO, or you're using an external source for that, I think just making sure that either the business owner or somebody within the company is able to kind of speak to the needs that the bank is going to be asking for. It makes the process go smoother. I think from our end, we try to make it efficient. I think it's not always going to be a yes, but I think if we collect the information quick, we're willing to evaluate it, and like a quick no is better than a drawn out maybe, or we'll see, or we're going to keep asking for information. So I think be open about it and try to have the information together. We're not going to, the SBA is a little bit different. We'll get into some of those requirements around what they might need to evaluate, but it's easy for us to do quick analysis and to kind of understand whether we're going to be able to get there or not.
Yeah, Kyle, anything you'd add? Nick will talk about Chris just alluded to the SBA goes to a different level here.
I'm going to give you a very banker answer to this, which is you got to be able to tell us the story, but you have to be able to show us the story with the numbers, right? Whether you're $1 million or 50 million, we need to be able to see it so we can do our underwriting. So,
yeah, Eric, anything to add?
Just add a little, on scope. So a $50,000 loan request is way different than a $30 million loan request. Pretty obvious, and it probably goes without saying, but there are levels of approval within every financial organization, and an individual might be able to sign off on a $50,000 loan request for a truck for your business, but then when you want to put an $8 million expansion on your building and buy $7 million of technology, that's going to add a whole nother 5 layers of scrutiny, questions, and approval within an organization. The levels of approval are less critical, I think, from a business owner's perspective, but understanding why the additional information is requested, understanding that both parties have the same goal. I mean, we want to get to yes. We really do. It's just sometimes it feels like we maybe don't. That's what I would add to that.
So let's pivot for just a minute to somebody who might be watching this later and they're an employee that wants to buy the business from the owner, or somebody that wants to buy an existing business that they found with a broker and so on, and they're looking to go into that endeavor of buying the business. What do they need to be ready for to see from? They want to go to a bank and get a loan to buy that business. How is that going to look for them, Kyle?
First hurdle when you're meeting with a bank or a banker that I'm thinking of when I meet with that person is can this person run the business? They've probably done a business plan, they've probably ran some numbers and done projections, but just evaluating, can this person elevate themselves from employee to employer? And many times the answer is no. The answer is they're not ready yet, or they don't know what they're signing up for. So that's the hardest part, I think, of those conversations is this person truly going to be able to step up to the plate and run the company and manage the payroll and the accounting and the people? They're probably really good at running the operations already. So that's the first one, is just, can this person do it?
Eric, more thoughts on that?
Second one is probably capital. More often than not, management buyouts or individuals that work within an organization who want to become owners need to find ways to do it gradually over time rather than a big lump sum. Imagine if I'm the chief sales officer for a $50 million company and the purchase price for the business is going to be $20 million, and I've managed to save $500,000 over the last 10 years. Well, that's not enough capital to pull off a traditional bank structured acquisition transaction. So maybe outside sources of capital, maybe seller financing. This is where from my perspective, this is where the fun conversation happens. It's how do you assess the situation? How do you talk about creative solutions or longer term planning to help position someone to buy, or alternative acquisition methods? Maybe it's acquire over time. Maybe it's find some other partners. Maybe it's find outside capital. Maybe you're not ready to do this yet, emotionally, or you don't have the intellect to pull it off yet. But having those conversations is really to me, is the fun part of the job. Problem solving, solution finding, and then advising. We up on this panel, we don't often get considered as advisors by business owners, but if we ask the right questions, we're probably pretty good at advising people on making good decisions.
Agree. Chris?
Yeah, we have these conversations all the time. I mean, there's a lot of this going on. There's unfortunately, there's a lack of succession planning in a lot of businesses, and I think you're seeing more things, like, I'm not going to get into ESOPs and private equity at this point, but that kind of stuff. Or you're seeing, hey, I've got a key employee, he's my succession plan. Well, to everybody's point here, that person, if they're ready, how are they going to pull that transaction off? So, you start with that conversation, and I think a lot of times if it's it's going to be a heavy seller financed deal at that point in time, or the SBA 7A program is a really good program for smaller companies that are looking to do an acquisition, because in most of those cases you're not going to have the collateral that you would typically have in a traditional bank deal.
Nick, anything you'd add? We'll jump into SBA in a little more depth, but as you have to see a lot of people that want to buy businesses with an SBA loan.
Absolutely. And, I just went through this exercise this afternoon of somebody wanting to buy a business for $10 million. Great. Give me the numbers. We start looking at the numbers, and it's like, okay, let's assume you put down 20% or $2 million. And what's it going to cost you to borrow $8 million? The way that business has performed the last 3 years doesn't generate enough cash to pay back the $8 million. So why are you going to invest $2 million to not get a return on your investment and to technically on paper lose money? And then people always come back and say, well, I can do this, 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 and this, which I get, but why are you paying the seller for that? So the biggest challenge I see in these transactions is coming up with a fair purchase price. And especially on the small business side, almost all the time that seller is going to think the business is worth more than it is.
And sometimes the buyer thinks that it's worth more than
Correct.
it is.
Yeah, the stars in the eyes, right? But it's like, I'm trying to tell you this is a bad idea.
Chris, you were going to add something there.
I was just going to say the valuation topic is a good one, just because it's for small businesses, a lot of times it is that the owner's got a number, or you might have an appraisal when it comes to the asset, but if you're trying to value the business, I think there's ways to do it without doing like a full-blown valuation or quality of earnings. There's firms in town that do sort of abbreviate it just to make sure that before you get in depth in that conversation that you're looking at what the true value of the company is.
Well, I think we've left Nick alone for long enough, so let's dive into the SBA programs for a little bit. Interested in everyone's thoughts, but Nick, where do you see the SBA programs as a good fit versus not, with buying businesses, expansions, and so on? Where do you see it work well?
Just happy to be back in business right now. Rough couple months. But no, it's, the SBA programs play a big role, right? And they lean probably more towards smaller size transactions. But, there's two marquee programs. There's the SBA 7A program, in which you get a loan directly through the lender, and then they in turn get a guarantee from SBA on that loan. That loan can really help with startup businesses, with fast-growing businesses, with change of ownership transactions, maybe kind of refinancing term debt, getting some longer terms, helping reset the balance sheet. So, typically the benefits of that program are going to be you'll put less money down than you would on a conventional basis, and you'll get to pay it back over a longer period of time. That being said, that program is primarily designed when there's not enough collateral to secure the loan. That's why the lender needs that guarantee, right? So there's a cost for that. So there's some upfront fees, and then there's some ongoing fees. So typically your interest rate's going to be a little bit higher than you would have on a conventional basis, but it still is a good deal when you consider your other sources of capital and the cost of those. So that program is used heavily. Most lenders offer that. There are some lenders that use it on a more frequent basis than others. That being said, right, I think the big banks that do a lot of these are typically some of the most expensive. So just because somebody does a lot of them doesn't mean that that's necessarily your best option to get one of those loans. Secondly, the 504 program, and that's what SBA specializes in, that's designed to help people purchase fixed assets. So we work with a lot of real estate, machinery and equipment, a lot of growing businesses looking to buy a building they're leasing or expand a building, new construction, new manufacturing lines. So that program is nice, and it's similar benefit in that you're going to put less money down than you would on a conventional basis. But under that program, you actually get a separate loan from WBD and SBA. So a lot of people call it the 50-40-10 program. So the bank would do 50%, we do 40%, the borrower would do 10%. Our 40%, the source of funds for those loans are bonds that are sold on Wall Street and guaranteed by the government. So I can offer 20 and 25-year fixed rate loans cheaper than what a bank can give you for 3 or 5 years in most cases. And so the value proposition is really you get to put less money down and you get better financing on a portion of the debt. And so it can work really well for growth companies. We talked about it before, one of the challenges with growth companies is you're taking a lot of that cash and those profits and you're reinvesting it back into the business. So, you may not have 20 or 25% to put down, or you have it to put down, but now you don't have that money to kind of fund your growth. And so really the thought is when we look at a transaction is how do we keep more money in that small business's pocket, hopefully so they grow and create jobs.
Yeah, so if I'm hearing you right, particularly on the 7A program, that can be where maybe the collateral isn't there as much as it would need to be there for a more traditional lending program, but the borrower is able to and willing to pay a little bit higher fees and a little bit higher interest rate to get something done.
Yeah, yep, absolutely. It's really designed to provide some mitigating factors to help that lender get comfortable, right? Because it's just not quite there on a conventional basis.
Yeah. Eric, places where you see the SBA work well versus not, anything you would expand on with Nick's comments?
I'm going to ignore your question and answer a different question.
He's going to take over as host here.
I just have two things to add. Not all banks are good or even competent at SBA lending. So don't make the assumption that just because someone has bank in their title that they have an appetite for SBA loans or are good at them, okay? Self-admittedly, we're not great at SBA loans. It's a totally different animal. There's a lot of stuff to them. Okay, that's point number one. Point number two, just because SBA exists doesn't mean a borrower is going to get an approval. Okay, the SBA, the WBD, they're still going to underwrite the loan. They're still going to have similar parameters as we do, and the deal needs to make sense in order to qualify and get an approval. You correct me if I'm wrong. Qualify and get an approval for a 504 loan or a 7A guaranteed loan. They still need to make sense. That was the only two things I wanted to add.
Great. Chris?
Yeah, 100%. We underwrite to management and cash flow. So it's a lot of times there might not be enough collateral, but there's a solid business there and the request makes sense.
Chris, anything where you see SBA work versus not work?
I would just say that some of the SBA, specifically 504 loans that we've done as a bank, that WBD has kind of partnered with us on, they couldn't have gotten done conventionally. So I look back and I think about some of the stuff you were talking about with the 20-year fix. And obviously we're in a little bit of an elevated rate environment, but you go back a few years and you kind of see what somebody can get a 20-year rate for 40% of their loan, and that's meaningful over time. So, I look at the 504 loans that our bank has done, and small companies, maybe they didn't have the amount of down payment they needed for conventional out of the gate, but to see where they've gone and to know that that was the way to get it done outside of a very unique structure. It's fun to look back at that.
Agree. Kyle?
It's not just a crutch to get something done. You can provide the benefits that SBA provides for someone that maybe does have the capital to put it in. If they want that long-term fixed rate, it isn't just because they can't afford the down payment. Sometimes it's truly the benefit of the program, not just using it as a crutch to make it where they can barely make it work.
Yeah, a little bit different in today's little bit higher rate environment, but certainly a few years ago that locking that SBA rate for 20 years was a really nice benefit. So
I mean, what is the 20 or 25-year rate now? It's still
pretty good. It's about 5.85 right now for a 25-year fix.
That's good. Yeah.
So, Nick, if you could elaborate, Eric touched on the lots of things needed part for an SBA loan. What does that process look like, and people being prepared for, because it is very involved.
Yeah, absolutely. And usually I start my pitch with, there's a lot of rules, and those rules create a box, right? So it's our job to understand that box and help fit you into it. So you do need to work with somebody who knows what they're doing, right? Because it's hard for anybody to kind of just start looking at it one time and try to figure it all out, right? And SBA won't admit this, but there is gray, right? And it's not all black and white. And so it's understanding how to work with these people and do it this way, don't do it that way. In general, 90% of what we need is the same thing that the bank is going to need to underwrite their request, right? There's a couple of additional forms that you're going to need on our side. I need to ask if you've ever been charged with a crime, right? If any pending lawsuits, kind of all that. Are you 100% U.S. citizen owned, new rule as of this year, right? Or legal permanent resident. So there is some eligibility factors we have to work through, and we want to work through them early in the process. But beyond that, it is an extended timeline, right? Because you have 3 approvals with my program, the bank, WBD, and SBA. Even if it's just the 7A program, you still have the bank and then SBA. So that SBA approval is going to take a couple more weeks, right? And so it's making sure we've got a reasonable timeline laid out that works for everybody. But we're going to move down parallel paths. We don't get paid unless we do the deal. So we're going to try to figure out early on if it's a deal that makes sense and it's a good fit. And if that's the case, then we start working through that process.
Kyle, how do you see the level of surprise people have when you walk them through the requirements for the SBA deal versus not? Does that scare people off?
I don't think it scares them off. I think a lot of times they already know, or they're expecting that. Maybe if we have someone who's been more of a traditional borrower, and then we're putting them into something in SBA, they're like, wow, this is a lot more. Yeah. But we all know from experience to just warn them, hey, it's going to be more. So it's not too bad.
Yeah. Eric or Chris, anything you'd add on that topic? No. Yeah. So how does that process differ? I mean, which is more cumbersome, the 7A program or the 504 program?
I think it really depends on the request, right? If it's a change of ownership request, which is often when the program gets used, it's going to be cumbersome, right? There is a lot of times going to be business valuation requirements. It's really understanding that the details of that purchase agreement, right? And so that can have an impact, right? Now, if it's just a simple refinance or term working capital, that's the other use for the program. You're growing, you need a larger line of credit than what your balance sheet supports. Those requests aren't as complicated, right? It becomes projection based and you have to understand the cash flow. But it's going to vary from one deal to the next. I mean, there's nuance. I would say the more partners you have involved, the more complexity there's going to be, right? If it's a single owner or just a couple of partners, it really shouldn't be that much more than what you'd have conventionally.
Great. Kyle,
I'll add one thing to that. Since we talked about acquisitions, typically there's seller financing involved. And when you have the SBA involved, there are very specific rules about the seller notes and when they can be repaid, et cetera, et cetera. So I always caution people early in the process for acquisitions is, number one, start asking your seller, warning them that they're going to be providing some equity into this deal and that, they may not love the terms that are going to be required by the bank on their seller note.
Great. Eric or Chris, anything to add there? Good. Nick, great having you here to, dive into that specialty area. That's, I hear it frequently. People think like, hey, I can't get a loan anywhere else. I'll just go to the SBA and get it. And lots of surprises behind that curtain once you go there. So pivoting for a second, acquisitions. So business has grown. They want to make their first acquisition. What does the bank look for there? How do those loan structures work? Chris, you alluded to sometimes, that's when cash flow deals are happening and maybe the collateral's not there. There's a, blue sky kind of gap to collateral versus what businesses want to pay. Eric, how do you see that process going a lot of times?
Not well. No, I'm just kidding. What I think the primary thing that business owners fail to grasp initially is that anytime they have a existing business, they're running the business, all the metrics look good and they find an acquisition target, they want to acquire that target, they go to the bank and start the conversation. They fail to understand that the risk profile of you as a business owner and borrower is going to change in some way, shape, or form because of this acquisition. Leverage profile is going to go up. There might be significant sub-debt, so the total funded debt to EBITDA might go up here and the senior funded debt to EBITDA might go up to here. The banker's looking at that and saying the risk profile is changing. Therefore, we have to ask a bunch of questions. Now, contrast that to a business that's kicking off $10 or $20 million in EBITDA. They want to do a little tack-on acquisition over here and incur another $4 million in debt or something like that. Way easier to assess because the risk profile only changes boop like that instead of boop like that. So a lot of it depends on the size, the scope. Is there a new geography that needs to be considered? Because I'm based in Madison and I want to buy a business in Indiana or Texas or fill in the blank. So there's a whole lot of those factors that need to come into play. But banks and lenders are typically going to start with how does the risk profile change? Specifically leverage. How big is the transaction in relation to my business? How big is the transaction or the future EBITDA to be generated from that transaction in relation to my EBITDA? What other risk factors might change as you navigate through the due diligence or underwriting process. So very few situations when it relates to acquisition can be put in a singular bucket because there are so many different factors to consider.
Yeah, Chris, how do you see that banking relationship change and the way things are being looked at change in an acquisition?
Yeah, well, I think the important thing to think about is I think a lot of companies have, they're obviously growing in certain ways. So it's organic growth, or maybe they are targeting acquisitions. It's probably nothing unless they just come across a company that kind of fits what they're looking for. But it's probably not a surprise. It's probably something that the company, the management team has been planning for. We are collecting whatever it is, quarterly, annual financial statements. A lot of times, I think clients think, we may not even look at those. And I think 10, 15 years ago, maybe that was the case. But I think one thing that we can do is add a little bit of value, maybe before that event even comes or that conversation even arises. We're getting financials, we're running trends, we're putting these financials into a system that spits out something that we can use to take to you and say, hey, here's what we see over the last 4 years, or if we look at an interim period, this is what I'm seeing. And then a lot of us have the ability to turn that into like a peer comparison to say, hey, this is what we see, this is what it looks like. And then you take it to the next level and you run what we call debt capacity scenarios, just to say, hey, if nothing else changes, you can build in incremental EBITDA or whatever it is to the model. But if you want to tack on a small acquisition, here's what your company can support from a cash flow perspective. So I think there's things we can do. We can be proactive about it, but talk to your banker too, to just say, hey, if I'm thinking about this, you've seen my company over the years, where does that stand today? So I think by the time we get to the need or the ask, hopefully some of those conversations have already been had.
Yeah. Kyle, anything you'd add in the acquisition scenario?
I giggled when Eric said it goes not well. I think my reason is I can relate to that, just as it is related to it becoming a distraction from the core operations. I think we can spreadsheet it and we can model it and we can add value in doing all those things, but through the years I feel myself adding more value and trying to coach that company, if they're not experienced in doing acquisitions, of how much of a distraction this may become. Yeah. It's shocking sometimes.
Yeah, that is a really great comment. It's, business, particularly with the business owner who is very integral to the existing business, and then they go to buy this additional business that is going to be off-site in another state. They're going to put their name on the line on that loan and so on, and their focus is now going to be taken out of town on a regular basis. Have seen that on more than one occasion. It can be a very quick downward trend if they're not careful. So, agreed.
Can I add on to that?
Yeah.
So one of the recurring themes between the first presenters and this conversation is that if you as a business owner proactively talk to your tax advisor throughout the course of the year about planning and deferring taxes or saving on taxes, you're going to be way better off at the end of the year. Similar to this conversation, if you as a business owner are contemplating acquisition, have the conversation. And as Chris alluded to, we can help assess your capacity to absorb acquisition, either simply or this one's going to be bigger, this one's going to be more complex. Here are things you should think about as you prepare for that. And it could be as simple as steps to enhance your own EBITDA, or it could be as simple as an introduction to an investment banker. It could be any number of things.
Yeah. Nick, anything you'd add acquisition-wise from SBA programs?
The only comment I would make is SBA looks at it different if it's vertical integration versus horizontal integration, right?
Yeah.
And that's specifically from a down payment perspective on my side, and so that is a factor too, right? Are you buying a similar business, or are you going upstream to try to get cost savings on basically your supplies?
Well said. Well said. We talked a little bit about things starting to not go well. Let's pivot and kind of go down the pit of despair here for a second. But Chris, you and I have been in at least one occasion, and sometimes things aren't going well. Tips to work with the bank when things are not the way they should be.
Just over communicate. It's simple, but I think the last thing we want to do is be surprised. And there's things that happen, but I think, if we know it's coming, the conversation goes a lot better. Because I think our job then is to be an advocate for the company to the decision makers within the bank or the leader, the whatever approval process that we go through. But if we don't have the information, or if we're coming after the fact, we've known something's been happening for months and we're just hearing about it, it creates an issue. It's challenging. I think things are going to come up, but just having the open-ended conversation, and then that's what kind of gets back to the tough conversations. It's better to be upfront with those things than to try to cover them up. You're gonna have to deal with it at some point down the road. So,
yeah. Bad news doesn't get better with time.
Well, and the other thing I'll mention, I think it's also important for the business owner or the CFO to have multiple contacts at the bank. I think in all of our places, there's probably a way for to get connected to at least one other person as part of the approval team. When I was at a larger institution before First Business, I think that was one of the changes. Is the team that was looking and evaluating our clients wasn't in market, and so I think to have multiple people that know the client is always an advantage.
Yeah. Kyle, anything you'd add there?
We're not allowed to have favorites, but we definitely do. And the ones who are our favorites are the ones who communicate well and communicate often. And having us, your banker, as an advocate for you when you're in a tough time is so important. If you're keeping things from me, I'm not as likely to go to bat as hard as I will if I feel strongly about our relationship.
Yeah. Eric, your thoughts on that?
Yeah, I would just add communication and information. Those are the two key components of a healthy relationship that get tested when things go a little bit sideways. Keep that information flowing, keep the honesty, communication lines open, much better outcome is likely.
I'm glad we got that out of the way. So
are we.
Yeah. Let's talk about deposits for a minute. Down the line here, everybody talked a lot about how that's where relationships start. What's new and exciting in the treasury management world today, and that people should know about? Kyle, why don't you start us off?
All right. Well, I think the first thing, most people think of bankers as lenders. That was the term that has been used for years and years and years, and I think all of us will tell you that's not the case anymore. We have to be conversational, we have to be educated, and we have to be helpful on the deposit side of the business. Every single business that we would do business with has treasury management, has deposits. Maybe, I don't know the percentage, but 50 or 60% borrow. Everyone has treasury, and we have to be able to help them manage their money, move their money, and protect their money. And there just continues to be more and more investment in technology in fintech companies, but at banks as well, to help our clients do all of those things. And it's just so important. And I think we could all talk about fraud for the rest of the time, but it's hitting all of our clients very frequently. It's shocking how often it happens, how often there are attempts at fraud, how often there are attempts at people hacking in to get people's logins and log into their online banking and start sending out money. So what's new and exciting? I think complacency is incredibly dangerous. You have to be having ongoing conversations, annual treasury reviews with your banker and your bank. It's so important.
Yeah. Eric, things you'd add? What's new and exciting in treasury management these days?
Well, I want to harp on the fraud thing a little bit because it literally is everywhere, and business owners and CFOs and finance departments cannot talk enough about it. And to me, in today's world, table stakes for every business need to be, You gotta have positive pay. You've gotta have a good internal communication and education system, specifically with your finance department, but even more broadly, because the bad actors don't care if you're an accounts payable person, an inventory person, or a production manager. They don't care. They're going to try and find a way in. So you got to have positive pay. You got to have a consistent education process for your folks. Even test them sometimes. My employer does it all the time. Once a month I get a spammy message and they're testing me, and if I click on the link, I got to take some stupid training. I don't want to take any training. So be diligent. Be diligent.
I feel like they got you last month.
No, it's been a year since they got me, but I remember it like it was yesterday. And the third thing is it's an easy thing to do. Talk to your insurance agent if you haven't yet. It's not a catch-all, but there are ways to manage that risk. And those are the three, in my mind, you guys may add, please do, those are the three must-haves for every business right now. As far as other like sexy stuff, there's integrated payables, there's ways to use technology, there's ways to simplify operations and payments and all that kind of stuff. We often get accused of trying to sell our clients stuff, specifically when it relates to treasury management, because we get more fee income or whatever. I would encourage business owners to not look at it that way, because our industry gets feedback all the time that, oh, we want our banker to reach out to us, and we want our banker to inform us about new technology, and we want our banker to be proactive. And then when we come out and share some of that information, we get accused of trying to sell them something. Well, if you would shift your mindset to be curious rather than feel like you're trying to be sold something, you're going to learn something in every one of those annual treasury management reviews. You're going to gather information. You're going to be able to assess, is this for me? Is this for my business? Am I not big enough for this tool yet? But if you're curious about that stuff, you're going to learn something new every time you have an annual treasury management review or ask a question about technology as it relates to our industry.
Yeah.
I think I'm good on that.
Cool. All right. Chris, anything you'd add?
Yeah, you guys hit it on the head. I mean, it's amazing. It's weekly, if not daily, with the fraud with our clients. Whether it's something that they're experiencing internal or whether it's something that we have found. But obviously basic stuff, but shifting more as much as you can to electronic payments. I do think a lot of what we still see is check fraud. Washing of checks, you mail check out, you've got your account number, routing number in there. So it's kind of old school stuff, but it's so important. And, talk within your companies. I mean, so many times we get the horror story of so-and-so sent me, an email to get this wire out. It's not the usual course of business. Instead of replying, walk over there, pick up the phone, have the conversation. Because when that money's out, it's really, really hard to get back when you're talking about wires. Just a couple other things. I think, just in treasury management in general, I mean, the rate environment is changing. Obviously, we were in a fairly high rate environment for a bit. That's starting to come down. I think it's just important to do the things and to have the conversations just to make sure that, if you were in a specific, high interest sweep account or you're paying for a line of credit sweep, that if the rate environment changes, you're making sure that those tools are still relative and relevant to your business. So you guys covered it. That's what's happening in that world.
Cool. What else is emerging out there for additional services in the banking world to help people be more efficient and safer? Kyle, you want to field that one first?
I mean, I think we just covered a lot of it. The payments space is probably where there's been the most change in how companies send money to each other. We've seen a huge ramp up in people paying each other with card, and I think that is still growing. However, there's becoming now more and more resistance to pay the card fees. So some people are kind of going away from card and back to ACH, but Eric mentioned integrated payables. That's essentially your company uploading one file to the bank, and we are sending checks, ACH and card, as elected by your clients, all in one file. So instead of 3 separate processes, it's one. I think that's probably the most exciting thing that we have going on.
Yeah, Eric, you mentioned that. I'm glad we came back to that. You want to expand on that a little bit? Integrated payables is a
I had to
pretty
Google
big
it before I came here, so here's what it says online, okay? Allows businesses to manage their all vendor and supplier payments from one platform. It creates efficiency and reduces cost. That's everything I know about integrated payables, you guys, but we all have team members that know a crap ton about it.
Chris, anything you'd want to add on all that?
That's what I do.
Do you have the crap ton for us?
Can I phone a friend on this? Yeah. I think the integrated payables is a good topic. I think, as people have lost, when you think about if you lose a payables person or somebody that's key in your accounting team, and you start to evaluate like the cost of replacement, and you think about ways to outsource some of that, it's something to consider. And we'll do like it's called a vendor match. It's getting kind of in the weeds, but we'll try to maximize what we can in terms of what that person can accept in form of a payment. So where you might be able to get rewards or a rebate for something that you traditionally paid via check or credit card, it could be something to consider. Outside of that, that's kind of what's happening.
No 50-year home mortgage? Or?
Not yet. Not yet. I wouldn't recommend that.
Horrible idea.
Hey, to wrap up, guys, I mean, what do you think companies should be seeing in a great banking relationship? Chris, you want to lead off on us on this one?
Yeah, I think we hammered a lot of this stuff. I think, if your banker's not coming to you with stuff, we joke a lot at our place, and unfortunately, I think our industry is known for, a lot of revolving doors, people moving. I think we've all been at our institutions for a while, but unfortunately, I think a lot of times all you need to do is return a call to kind of be above everybody else, and that's a terrible thing. But in all honesty, I think you expect more than that. I mean, I think your banker should be proactive. You shouldn't always have to ask the question. We should be coming to you with ideas. We should be coming to you with changes that are happening in the industry, changes that can impact your business. And then I think, just having the open two-way communication is just the key to any relationship, really. Final thought on, you mentioned it earlier about the bankers not being at the table as much, maybe as an advisor. I've got a couple of clients that bring everybody together on an annual basis. It's called an annual stakeholder meeting, and it's the accountant, it's the insurance company, it's the attorney, it's the banker, it's their key management team, and all it is just State of the Union, here's where we stand, and then everybody gets to give their perspective around kind of what's happening. And I think it's simple, but it's super impactful. And I leave that meeting every year thinking, wow, I learned something from everybody in that room, and I think it just creates a little bit more synergy.
Yeah, great. That's a great point.
That's an exceptional idea. I've suggested it to numerous clients. I only have 2 that actually will do that. I haven't figured out why others won't, if it's a time commitment or hiding stuff or whatever. I don't know. Maybe because they have to pay their attorney and their accountant to be there. But just to summarize, from my perspective, every business owner should expect the following 4 things: fit, consistency, service, and communication. If you're getting the typical call I get when I'm prospecting businesses, and I'm patient, so I'll keep dripping, and when do you want to talk? Let's have coffee. When do you want to talk? The primary reason for the phone to finally ring is I can't get my bank to return my phone call, to Chris's point. Or crappy service. We can't get an answer over a simple treasury management question. And that's usually just the straw that breaks the camel's back. There's other stuff. But if your banking relationship has those 4 things, consider yourself good.
Kyle, things you'd add to this?
I would say pick your banker because they're a good banker, not because they're going to take you out golfing all the time, or I think bankers get a bad rap that we're just spend all summer on the golf course, but the reality is
Only half of the summer.
but yeah, maybe that relationship comes, but pick someone who's good at what they do and is passionate about helping you more than passionate about trying to entertain you and have fun. Yes, that's part of our job, is to do that, but that's supportive of our core task, right? So pick somebody that's going to be there for you when you need them.
Nick, anything you'd add from your experience, because you work with a lot of banks, right?
Yeah, I would just say, it's almost to bring it full circle back to fit, right? And understanding different banks, and there's going to be banks, large national banks, that throw rates at you that are very attractive, but you are not going to have somebody you can call for treasury management. You are not going to have a lender that you have a long-term relationship with, right? It makes a difference. And we primarily partner with community banks because it's relationship-based lending, right? It's not a one-off transaction. It's not trying to get the most return out of that single deal, because if it is, they're not going to use us, right? Because they're not going to have as big of a loan balance. So definitely a great group here. I think the experience makes a difference, but I also think, making sure that you're with the right lender and the right, lending institution.
Any additional questions from the crowd?
So Eric, you mentioned this, I think, just briefly in one sentence, but can all of you, if I wanted to make an acquisition, could you lead me to outside capital in order to make the deal potentially work, if I needed that in addition to your lending abilities?
I think all of us have probably relationships, whether it be, there's private equity, that's a whole nother avenue, or there's mezz financing. When you look at kind of the different layers that could be, I think we all have probably connections either in-house or externally that could be that solution. So it's going to depend on a variety of factors, but I think there's usually several. It's rarely 100% bank debt, so then you kind of got to go down to the next level. Obviously, it's going to be more expensive once you get out of that traditional program, but
Sure. No, that makes sense.
yeah.
Actually, I got a second question too. As we navigate our way toward the end of the year here, what do you guys, and you talk to your customers and your clients, what are you seeing out there? What are the expectations in terms of rounding out that final quarter of the year and going into 26? And I'm in the manufacturing industry, so I guess I'm most interested in that area, if you can cover it.
Start down there, because Kyle had some insights before the event started.
I would say in the last 6 months, we've started to see our clients, specifically in manufacturing, start to kind of open up the coffers again and start spending money and making investments on CapEx. From maybe first half of this year and all of last year, everyone was sitting on their hands for various, either interest rate, political reasons, and now they're saying, hey, I have enough backlog, I have enough confidence to start making decisions to invest and doing that expansion or buying the equipment. I think we're seeing that start to open up a little bit, just from a general industry perspective. That's what I'm seeing.
Yeah, I think for the most part, clients are doing well. Not record years, but doing well. I was at a WMC event a couple of weeks ago with some large manufacturers around the state, and there's a lot of talk around tariff impact, and I think the theme was everybody felt, for the most part, they felt like it's warranted, and maybe some short-term pain would ultimately help the business, but that doesn't change the fact that they talked about numerically how they're off from, these are large companies that might work with people that are really getting impacted by some of the tariffs. So I think that's a real thing, and I don't know that we've seen the full extent of it. So that's pause, I think, for some of the higher end or larger end manufacturers. I work a lot in the construction space, and contractors, especially if you're in Dane County, you're a commercial contractor, and you've got diversity within municipalities, the university, multifamily, it's still gangbusters, and there hasn't been a slowdown there. I think some of the engineers and architects I've talked to have said similar things, where there was maybe a pause, whether it be costs or interest rates. or tariffs, and I think they're starting to see the deal flow that they saw 12 to 18 months ago as well. So overall, I would say very positive.
Yeah, I would just add that rewind 12 months, business owners, I feel, were looking for reasons to not reinvest in their business or expand, or finding reasons to be cautious rather than optimistic. And fast forward to today, I've had probably, this is just a microcosm here, so just me, I've probably had 5 conversations with clients or prospects in the last 45 days about CapEx spending and investing in their business in 2026. So it feels better, more momentum, and I think it's largely, I mean, there's still tariff uncertainty, right? There's still war stuff going on, right? But I think business owners are at a point where they're looking for the optimism of the future rather than maybe the cautious pessimism that existed 12 months ago, 18 months ago.
Other questions? Brian?
Yeah, I'm curious what you guys see for companies that are working with multiple banks. So maybe I have my treasury management and all my deposits with one of you, but I'm going to a different bank for lending. So is that common, or are you lending to mostly people that you're doing their treasury management for, or what do you guys see?
I think all of us will tell you that we want to be your bank for all of those services, unless the borrowing package is so large that we're sharing it with each other. But in general, if someone's coming to us and asking for a loan, it's most of the time table stakes to say, with the loan comes the treasury. You guys agree with that?
I would agree, yeah. At least the operating account 99% of the time.
Yeah.
I mean, I think there's some companies that have different tranches of cash, short-term liquidity, mid and long, and then sometimes there's a place for a couple of different banks in that. But generally, whoever has kind of the main lending relationship would have the operating relationship as well.
Yeah, there are some businesses that just have it a policy, we're going to have 2 banks. Maybe they got burned, at one time in the past. Maybe their credit needs exceed that of one bank. So I think it's entirely dependent on the circumstances. But if you're a business owner or a CFO and you can find banks that will do that and it works for you, more power to you. But generally speaking, we look at it as a package deal.
Other questions?
Earlier, you guys were talking about employees buying companies, and you guys mentioned that you kind of look to see, like, can this employee actually run the company? What are some of the characteristics you're looking for when you're making that decision?
Well, I don't have a fancy checklist. I'm not gonna, hide from that. It's a feeling. I think a lot of the time, you said it too. You're evaluating management and cash flow, and is this person, how entrepreneurial are they? Sometimes, like, they're too entrepreneurial, right? They have all these ideas, and they really just need to run the business. I don't have a really fancy answer to your question, to be honest. It's oftentimes in the way this person is approaching the conversation and the information they're providing. Does that give me confidence, or does it give me pause?
Yeah, I would agree with that.
I would add a kind of a tangible response to that. If the business owner, the current business owner, is prepping for sale, one of the things that every one of us would advise is that the business owner should make sure their management team is running the business, and they should figure out a way, the owner should figure out a way to remove themselves from the day-to-day so that all of us can see, hey, the management team is running the show, or Sally's running the show. And the business isn't going to fall apart just because business owner leaves. But what happens so often in small business, and I define small business as revenue under 25 million, okay? Business owner is either too egotistical or too ingrained in the business to allow themselves to be pulled out. And they're doing themselves a disservice when it comes to preparing the company for sale in that scenario. Because any buyer, whether it's PE or a management company or any lender, is going to look at who's actually running the show. Fair?
I wish I would have said that.
All right. Any other questions? Otherwise,
Read the E-Myth. If you have questions about that, there's a question about it. The person that you're talking to is questioning whether they can, or you're questioning whether that individual can tackle that or not. You know, I've always looked to that simple book that's been out for years and years, written by Michael Gerber, called The E-Myth. And it talks about that engineer that wants to open its own business because he loves to do engineering work, so he gets constantly bombarded by all these other things that people want him to do, and he wants to do engineering work, so he wants to open his own firm. And it's all about, well, he opens his own firm and finds out what's his business. When I did business valuation discussions, I'd start and end the conversation with the question, what's your business? As a business owner in front of me right now, what's your business? And people would say, I install windows, I do construction, I'm an engineer. I was like, no, that's not your business. Your business is your business. That's what you're gonna sell someday. That's what you're after. You're investing all this money, time, energy, and emotions into this thing that you show up to every day. Your business isn't engineering, it isn't manufacturing. It's, as the business owner, your business is your business. You're trying every day to make it around that cash flow circle as efficiently and quickly as you possibly can to generate cash, to stay in business. And that's your job. It's not engineering, it's not construction, it's not banking. You know, if you're the owner, that's your business, it's the business.
well said. Any other comments? Guys, thank you very much. Great panel.